Hello, you are welcome to this lecture. In this lecture, we are looking at session 3 of unit 3. In session 3, we are looking at audit risks and materiality assessment. Audit risks and materiality assessment. And it's part of unit 3, which is dealing with audit planning and documentation. So at the end of this session, you should be able to describe the types of risks associated with audit assignment and describe the procedure for establishing materiality. So these are the two objectives that must be achieved at the end of this session. Now let's look at risk-based audit. Now risk-based audit is a system of audit used by auditors in order to concentrate on high-risk clients and on high-risk areas of the client's business rather than performing detailed audit tests on all areas of a client's business. So you assess the client to see if it is a risky client or the areas of the client's business are of high risk. If that, then more attention must be focused there. Now, the riskier the client, the more work the auditor will have to do in coming out with the audit opinion. Now, let's look at audit risks. Audit risks. Audit risk is the risk that an auditor may give an inappropriate audit opinion on the financial statement when there is a material misstatement. So this material misstatement could happen that the auditor might not be aware of it, and as a result of that give an inappropriate opinion, and that is what we call the audit risk. Now audit risk has three main components. We have the inherent risk, the control risk, and the detection risk. These three come together to form what we call the audit risk, and we'll be looking at each of these components into detail. Now let's take the first one, which is inherent risks. The inherent risks. The inherent risk simply has to do with the susceptibility of a relevant assertion to a misstatement that could be material, either individually or when aggregated with other misstatements, assuming there are no related controls. So there is no related control there. And then it is the risk of misstatement of an item due to its nature. So there is a material misstatement due to the nature of an item being treated. So an example is comparing inventory and cash. Some inventories may have higher inherent risks due to valuation basis. So you have value some inventory. You ask yourself the nature, what is the basis of the valuation? What is the qualification of the valuer? Can this value be relied upon? So the nature of the item itself pose some inherent risks which will cause this material misstatement, enabling or which will make the auditor give an inappropriate opinion. Now, what are some of the factors that affect inherent risks? So we want to look at the factors at the client level or the overall level. So you look at the integrity of directors and management. We have to look at the management experience and changes in management. So what are the experience of management and what has been the changes in management? You have to look at industrial factors such as competition, legislation, and others. Then the nature of the business itself must also be considered. It's also a factor that affects the inherent risk. And here we are looking at the technological changes that affect the business. And all these are factors that affect the inherent risk at the client or the overall level. Now, these factors can also be due to a class of a transaction. And with this, we are looking at the complexity of underlying transactions. Some transactions come with some complicated or recordings and all those ones. Then you look at the susceptibility to loss or theft, that some of these items could be stolen. Then you look at the quality of the accounting system in place, and this could also cause material misstatement due to the nature of the item and then the systems in place. So these are some of the factors that affect the inherent risk, both at the class of the transaction and then the overall or the business or client level. Now let's take control risks. Control risks. Now, control risk, this is the risk that a misstatement could occur in an account balance that could be material, whether individually or when aggregated with other misstatements. You are saying that a risk that material misstatement could occur in an account balance that could be material. So this misstatement could be material, and it can happen at the individual level or when we aggregate all the items together. Now, it is a proof of the effectiveness or otherwise of design and operations of internal control. So, if internal controls are working effectively, then the controls are in place, which is going to reduce the control risks. Now, we access internal control in two ways. We have the control environment and control procedures. The control environment and then the control procedures. So the control environment includes the attitude, the awareness of those charged with governance concerning the entity's internal control and its importance in the entity. The control environment also includes the governance and management functions and sets the times of an organization, influences the internal control consequences of its people. Now, this control environment serves as the foundation of discipline and structure in the organization. Now, the other element of the control, internal control, is the control procedures. And the control procedures are basically the policies and procedures by management to support the business objectives. So an example of this is approval and control of documents, the maintenance and review of accounts, reconciliation, limiting direct access to controls, and then control password. So these are what form the control procedures and then the control environment. These two come together to form the internal control. And we said the internal control is if they are working effectively, it is a proof to control risks in the entity. Now let's look at detection risk. Detection risk. Now detection risk is a risk that the auditor will not detect a misstatement that exists in a relevant assertion that could be material, either initially or when aggregated with other misstatements. So this risk is coming from the auditor, that when you perform your assessment, you should be able to identify some misstatement. And if you are not able to identify a misstatement that exists, then we are saying that it becomes a detection risk. So you have to detect this particular one. Now, this detection risk is a proof of effectiveness of the audit procedures. So the audit procedures that you are outlined for yourself to be able to assess if there is any risk and to reduce it. The effectiveness of this will be tested when with regards to risk detection. Now, to get the total audit risk, it is made up of the inherent risk times the control risk times the detection risk. Now, detection risk is coming from the auditor. The control risk is coming from the internal controls in the firm, and then the inherent has to do with the nature of the transaction, complexity of the transaction, and these three come together to form the total audit risk, or what we call audit risk. So audit risk, as we say, has three components: inherent risk, control risk, and then the detection. Now let's look at materiality. Materiality. Now, an item is material if its omission would reasonably influence the decision of an addressee of the audit report. So we define audit or materiality as an information on an item is material if its omission could influence the decision that the user will take at the end of the day. Now, auditors need to consider materiality at two levels. That is account balance level, and this is done at the planning stage to guide audit staff. So you do or you set this materiality at the account balance level. Then you do it at the second level is at the overall financial statement level. The overall financial statement level. And this is done at the review stage to assess effect on true and fairness. To assess the effect of true and fairness. Now, as auditors, we need to set materiality for risks before conclusion could be drawn. So, auditors will need to assess the materiality of transactions and risks at various stages of the auditing assignment. Now, what may be material in one instance may not necessarily be material in another instance. And all this depend on what? Several factors. Due to the nature of the business and then the size of the business, what is material to one entity would not be material to the other entity. So materiality is a subjective something. It depends upon the size and the nature. In one circumstance it will be material, in the others it could not be material. Now, materiality, as we said, it depends on certain factors. Now, some of these determinants of materiality are, we look at the size of the item, the influence on the user, then the nature of transactions, as I mentioned earlier. Now, as a guide, percentages are sometimes used. So auditors often use percentages as guide and determine what would need further investigation, explanation, or disclosure. An example may include that you want to set materiality that for the financial statement, if the item fall within 0.5% to 1% of turnover, which is your revenue, then it is material. It fall within 1% to 2% of total asset, then that is material. And then from 5% to 10% of your profit before tax, then that is material. So it depends upon what, and then all this must be said before the audit actually begins. Now, what is the relationship between materiality and audit risks? What is the relationship between materiality and audit risks? Now, there is an inverse relationship between materiality and the level of audit risks. That is, the higher the materiality level, the lower the audit risk, and vice versa. So auditors will need to assess the materiality of transaction and risks at various stages of the auditing assignment. What may be material in one instance, as we said, may not necessarily be material in the other instance. And this also depends on several factors as mentioned. Now, we take the first instance. If the audit risk is high, so where the audit risk is high, the likelihood of detecting misstatement is very low. Now, that is, even though material misstatements exist, the auditor may miss them. And the actions that needs to be taken is that the auditor would need to minimize the audit risks by increasing the sample size to be worked on, by doing substantive testing, and then a third-party evidence must also be sorted if the audit risk is high. Now, in a second instance, if the audit risk is low, it means that there is less chance of misstatement in the assertion, and the auditor may therefore reduce the smaller or reduce the sample size and also rely on systems to be able to arrive at a conclusion. Now, if you identify a misstatement, how do you communicate these errors to management? So, material misstatements are identified resulting from error. Some are error. This should be communicated to the appropriate level of management on timely basis, and the auditor should consider the need to report it to those charged with governance. Yeah, human beings are bound to make errors. So if some of these misstatements are as a result of error, those charged with governance should be informed on timely basis for those errors to be corrected, and which must reflect in the financial statement. So in summary, we have looked at risk-based audit. We learned that audit risk is made up of three components, namely inherent risk, control risk, and detection risk. Try read more on the topic to gain more understanding. Thank you and see you in the next session.